Happy Monday, traders, and welcome to a fresh week in markets. So something very important, something very meaningful happened at the end of last week, and it is something that we have talked about quite a bit in the previous market updates, and that is what is happening to bond yields. Yes, we're finally having a market that is taking note. End of last week on Friday, US 2 yields went not only through 4%, but put another 8 basis points on top of that and closed up towards almost 4.1%. Huge move. So we've broken that psychological level and spiked. US 10-year yields, we talked about it, 4.5% was a big level. It was a big technical level as well. Market now has broken above that, and we've seen US 10-year yields now spike up to pretty much close up towards 4.6%. So look, these yield moves, this is the highest that we've seen US yields for over a year, and it is significant. And it's obviously happening because crude oil prices are pushing inflation higher. We saw that inflation print last week in the US up at 3.8%. Analysts now are coming out and thinking that US inflation has got scope to go as far up as 6%. And it's not only just US yields that are going up, it's globally all bond yields are also rising as well. So look, with these rising bond yields, it is a big negative for the market, and we saw the market finally react on Friday to these surging bond yields. So US equities, which have been pretty much the strong link in the equity space in the last month and a half, we have seen them on a massive bull run, making new record highs, surging higher, one-way train. And finally, we saw a reversal. The equity market started to lock in some profits, starting to get a little bit worried. So S&P, which was trading record highs above 7,500, dropped about 120 points on Friday. And then also NASDAQ, which was pushing up to almost 30,000, is back down towards and trading at 29,000. So some decent reversals so far in the equity space. So look, how far can we go? Well, look, it's going to depend on what happens to bond yields. So we haven't seen them open yet for the week, but I can imagine that at the moment there's no real reason for seeing some sort of reversal in those yields or anything meaningful anyway. For the simple fact is that you need crude lower, and crude oil has started the week making fresh gains. It's up just over 1% so far, so crude is not doing any favors to the market. And the reason why crude is not going lower is because obviously we haven't got any sort of resolution between the US and Iran. They're still at a stalemate. They're not close to making any sort of deal. But not only that, it seems as if Trump is losing patience, and there is a lot of nervousness in the market that the war could re-escalate in coming days or at any stage now. That happens, obviously, it's going to be a massive negative for the market. Look, I would suggest that if that does happen, we're going to see a crude oil spike, take out that $120 high that we saw at the start of the war, and record highs for crude are up around that almost towards 150 at 147 and a half. You don't want crude going anywhere near there because that is going to cause some serious damage to markets. But look, this is a risk that at the moment certainly the market can't ignore, and if you are trading, you can't ignore this. So the fact that yes, we could re-escalate with military action again in the short term is probably the biggest focus at the moment for this market, and obviously crude, because crude making those sort of gains obviously is going to get bond yields spiking even further, potentially getting US 10-year yields back up towards 5% in the short term. So In other markets, obviously precious metals last week had some big falls. We saw silver down a good $10, absolutely smoked. Gold on Friday, $150 as well, pushing back down towards 4,500. And I'd suggest again, the thing about precious metals, especially gold, it yields nothing. It's just a shiny yellow metal. That we continue to see these bond yields higher. Buying the dip in precious metals is not going to work. Potentially we can see more vicious cleanouts to the downside. So buyers at the moment staying short or selling any sort of strength retracements at the moment. In the currency space, yes, the currency space has certainly been active as well. The surging US yields have spiked the USD. So we've got dollar index DXY at the moment trading back above 99. It's around 99.30. Key level to watch there top side is 100. The US dollar has been trading sideways for a good year. 96 in the dollar index up to 100. Every time it's got to those extremes on the downside, top side, it's retraced back into the range. I'd suggest if we did go back to a military conflict, we're going to go straight through 100 on the dollar index. It's going to go a lot higher, especially if we break that extended range, and it's a meaningful break. So I would not be selling USD at the moment because certainly you would be going against something that potentially could be a new trending market breaking 100 on DXY. So look, just to wrap it up, there's obviously a lot of concern in the market at the moment. The biggest concern obviously is what's happening with US and Iran, potentially that Trump's running out of patience. This goes back into a military conflict. If it does, which high probability, then these markets are not going to like it. You're going to see crude oil a lot higher. You're going to see bond yields a lot higher. You're going to see equities a lot lower, and USD a lot higher, precious metals a lot lower. So good luck with your trades, and we'll check back in with you shortly.